Welcome back to the deep dive. Today, we are doing something a little different, a bit more granular. We're looking inside the financial engine of a major home furnishings company.
And we're not talking about marketing or, consumer trends. We are going straight to the source.
Exactly. Straight to the chief financial officer's opening monologue from their Q3 fiscal 2025 earnings call. This is the story from the person who's actually holding the purse strings.
And it is a compelling story, mostly because the environment right now is just, well, it's brutal. The CFO himself said they're dealing with historically low housing turnover and these massive volatile tariff headwinds.
Right.
So our mission today is to figure out how, against that backdrop, they delivered something that feels completely counterintuitive.
Which is positive comparable sales for the fourth straight quarter, and they expanded their margins.
It doesn't add up on the surface.
Yeah.
So you need to break down the 5 core competitive advantages they're claiming, look at the surprisingly strong Q3 results, and then, really clarify the updated guidance for the rest of the year.
It's such a key point. I mean, when people aren't moving, they typically are not buying big-ticket furniture. So the fact that this company isn't just surviving, but you could say thriving. Couple posting a positive 4% comp growth and improving profitability, it just tells you that their success has to be structural. It's not about a favorable market tide. It's about having a perfectly tuned engine.
Let's start with that engine then. The CFO laid out 5 very specific competitive advantages. These are the pillars that he argues explain why their results seem to defy the market gravity that's pulling down their competitors.
Okay, let's unpack this blueprint. First up is the sheer strength of their multi-brand portfolio. We're talking different categories, different aesthetics, and this is critical, different price points.
Right. So they aren't tied to a single type of customer or a single income bracket. If the high-end buyer pulls back a little, they might capture the, let's say, aspirational middle market customer with another one of their brands. It just minimizes their vulnerability.
Okay, so that's one. The second advantage is simply their size and scale. How does that translate into an edge beyond, just having a lot of money?
Well, it lets them maximize what they call white space opportunities. Because they're so big, they can dedicate capital to quickly enter and just dominate these niche, fast-growing areas.
You mean like Dorm, West Elm Kids, that sort of thing?
Exactly. Think about Dorm, West Elm Kids, or even their B2B division. These are growth levers that smaller competitors just can't afford to pull so aggressively.
Yeah.
That size drives market share even when the overall pie isn't really growing.
And that leads right into number 3, which is the multi-channel platform. Online, in-store, B2B.
They're everywhere.
They're making sure that if you want to buy a sofa at 2 in the morning on your phone, or you want to actually sit on it in a showroom, or maybe a hotel needs 500 chairs, they can handle all of it seamlessly.
And the fourth advantage is more inward-looking. It's this deep commitment to customer service and, importantly, prioritizing full-price selling. The CFO noted this isn't just a feel-good strategy. It's an efficiency strategy.
Better service and fewer promotions means fewer returns.
Fewer returns, fewer damages, fewer operational headaches all around.
Which flows perfectly into advantage number 5, the power of their operating model to deliver highly profitable earnings. Basically, the other 4 advantages create such a smooth pipeline that profitability becomes, I guess, predictable.
Predictable, yeah. Regardless of small market fluctuations. And that model absolutely performed in Q3. The headlines were net revenue at $1.88 billion with that positive 4% comp growth.
And earnings per share grew 5% year over year, hitting $1.96 per share.
The really fascinating part, though, is where that growth came from. It wasn't traditional. It was those white space initiatives. Dorm, kids, rejuvenation. They paid off big time, posting double-digit growth.
And looking at the channels, the retail stores were remarkably strong, up 8.5% on a comparable basis. E-commerce was up a respectable 1.9%.
That 8.5% retail number, it really underscores a key point about the consumer here. They still value that in-person experience,
Yeah.
especially for big-ticket items. Their digital-first strategy works best when it's supported by physical stores.
Yeah, that makes sense. And to link back to efficiency, the CFO made a really strong claim about the supply chain team achieving best ever results across service metrics on time delivery, damage reduction, while, and this is the key part, simultaneously cutting costs.
That is a tough thing to do. It's a dual achievement, and it perfectly sets the stage for the big surprise we need to talk about next, which is the margin story.
Okay, this is where it gets really interesting. The market was basically braced for tariff pain, yet the company's gross margin came in at 46.1%. Not only is that high, it's 70 basis points higher than last year.
And for anyone who doesn't track this daily, 70 basis points of expansion, that's 0.7% of every dollar of sales in this kind of inflationary, tariff-heavy environment is, well, it's exceptional.
So why was it so exceptional? What happened?
It was exceptional because it wasn't luck. It was a very calculated tactical delay. The CFO broke down that 70 basis point improvement into two buckets: higher merchandise margins and supply chain efficiencies.
Let's focus on the merchandise margins first, because that was 60 of the 70 basis points. He broke this down into three key factors.
Okay, so factor one, and this is the most crucial for the story, was a delay in the full tariff impact. They didn't solve the tariff problem. This was a tactical maneuver.
What kind of maneuver?
The delay happened because some new tariff-effective dates were pushed back, and the company made a very strategic call to aggressively front-load inventory. They bought huge quantities before the new higher rates kicked in.
So they basically used their balance sheet and their scale to buy themselves, like 3 months of breathing room and guarantee Q3 profitability, knowing that the full financial cliff was waiting for them in Q4.
Precisely. It's a huge gamble.
It is a huge gamble on sustained consumer demand.
It is. They bought inventory at the old, lower rates, and they're selling it now at current prices, which gives them that margin cushion. Factor two was just the success of their 6-point tariff mitigation plan, which included some select price increases.
And consumers paid them.
The strong response to their full-price product validated their strategy. People are paying full price because they value the brand, not just the discount. And then factor three was a small win: lower inbound transportation costs, which helped offset some of the tariff costs they did absorb.
Okay, so that's the merchandise side. What about the second driver, the supply chain efficiencies? You said that added 30 basis points.
Right, and this ties directly back to that customer service commitment. The CFO noted these savings came from reduced accommodations, so less money spent fixing customer issues, fewer damages, fewer replacements, and optimizing their shipping expenses. When your process is tighter, your costs just drop.
Okay, but even with those savings, their SG&A selling, general, and admin expenses ran 60 basis points higher year over year. It hit 29.1% of revenues. Doesn't rising overhead kind of raise a red flag?
It's an important question, and the CFO was very specific about it. The increase came almost entirely from employment expense, which deleveraged by 50 basis points. But he attributed this solely to higher incentive compensation.
Meaning bonuses?
Meaning bonuses, yeah. They paid out bigger bonuses because they hit bigger targets. So it's a purposeful rise in cost that reflects success, not, inefficiency or failure.
And advertising was up too, by 20 basis points. Why increase ad spend in such a tight market?
It was strategic. Their own proprietary in-house analytics showed them they could scale their digital ads efficiently. So that higher spend actually drove accelerated site traffic and improved the revenue per visit. The investment paid for itself almost immediately.
So they nailed the quarter by managing inventory and optimizing operations. But a fortress balance sheet is only useful if you actually use it. Let's look at how they're deploying that cash. The CFO was very proud of their fortress balance sheet: $885 million in cash and, crucially, zero outstanding debt.
That cash position is their strategic war chest. And it's absolutely necessary given the tariff challenges that are coming. They generated $316 million in operating cash flow just in Q3.
And what about spending going forward?
For fiscal 25, their CapEx is projected at $250 to $275 million. And 85% of that is focused right back on enhancing those 5 competitive advantages we talked about: e-commerce, retail optimization, and supply chain.
They're also really aggressive with shareholder returns. $347 million back to shareholders in Q3 alone.
Yep, that's split between $267 million in stock buybacks and $80 million in dividends. And get this, it's their 16th consecutive year of increasing the dividend payout. It's up to 66 cents per share now.
And the board just approved another $1 billion share repurchase authorization. That sends a very strong signal about their confidence in future cash flow.
It does. But now we get to the critical part, the guidance. Before he could give the update, the CFO had to do some housekeeping, as he called it, basically clarifying some complex prior year adjustments so analysts weren't comparing apples to oranges.
And this is so critical for the Q4 outlook. They had 2 big things to explain away. First, they had to remove a $49 million adjustment from Q1 of last year that had artificially inflated last year's operating margin.
Right, by 70 basis points. And the second, much bigger issue was normalizing for the 53rd week in fiscal year 2024.
The extra week.
The extra week. Think of it this way. Q4 last year was effectively a 13-week quarter. This year, Q4 is only a 12-week quarter running against those record numbers. The CFO said the impact of that extra week was a massive 510 basis points to revenue.
510.
That is literally the value of a whole extra week of sales that they just don't have this year.
Yeah.
And it was 60 basis points to operating margin.
Those are really difficult headwinds. And yet, they updated their full-year guidance. They kept the top line, the same reiterated comp guidance of +2% to +5%.
But, and this is the key, they raised the bottom line.
Yeah.
They increased the operating margin guidance by 40 basis points. The new range is 17.8 to 18.1%. It just reflects the strength of their Q3 beat.
Okay, but here's the tension, right? The necessary caveat. They're raising the overall guidance, but the CFO explicitly stated that this includes the expectation that tariffs will have a substantially larger impact on margins in Q4 than they did in Q3.
The honeymoon is over. The full weight of the political and trade environment is about to land. The incremental tariff rate they're facing has effectively doubled, from about 14% earlier this year to 29% today.
Doubled.
It's doubled. And it covers major categories, revised China tariffs, the 50% tariff on some Indian products. Their mitigation plan is baked into the numbers. But imagine trying to paddle against a current that just suddenly doubled in speed. The pressure is immense.
Even with that very real Q4 caution, the long-term vision is still optimistic. They reiterated guidance for mid to high single-digit revenue growth with op margins in the mid to high teens for the long term.
And the CFO closed by tying everything right back to those strategic reasons why they believe they can sustain this. It was a perfect summary of their core strengths.
Let me guess, the 5 advantages.
You got it. Their ability to gain market share, the strength of their in-house design, that digital-first but not digital-only strategy, the growth initiatives, and of course the resilience of that zero-debt fortress balance sheet.
So the core takeaway for you, the listener, is that Q3 was really a strategic victory built on tactical delay and operational brilliance. They just maximized the window before that full tariff wave hit.
Exactly. They used aggressive inventory front-loading, and they achieved unprecedented efficiency and full-price selling. The insight here is really in the trade-off. They executed a perfect quarter, but now they are facing a Q4 where the tariff rate has effectively doubled. The question isn't whether they can weather it, but what they'll have to sacrifice to do so.
Which brings us to the provocative thought to leave you with. Given that this company is hitting record customer service metrics and supply chain efficiency, all while successfully raising prices, how long can this operating model continue to offset a tariff rate that has more than doubled from 14% to 29% without eventually having to compromise on that full price selling or, worse, impacting consumer demand?
That is the real strategic challenge we'll be watching as those Q4 numbers roll in. A phenomenal summary of the road ahead.
Thanks for joining us for this deep dive.